Hey guys, this is Vyom Joshi with Superior North. Welcome back to my channel. Today we'll go over a business called USD Partners LP. USD Partners LP is engaged in energy-related logistics assets, which include rail terminals and other midstream infrastructure. In this video, we'll go through the company's business by focusing on its 10K, then review the company's fundamentals by going over its key ratios, and finally find the intrinsic value of the company. So let's dive in and review USD Partners LP.
Hey guys, let's start off by looking at the Form 10K, which is the annual report that USD Partners LP filed with the SEC. On page 7 of this report, the company provides us a business overview. The company states that it is a fee-based, growth-oriented master limited partnership that was formed back in 2014 by US Development Group LLC. The whole purpose of this formation was to acquire, develop, and operate midstream infrastructure and complementary logistics solutions for crude oil, biofuels, and other energy-related products. The company generates substantially all of its operating cash flows from multi-year take-or-pay contracts with primarily investment-grade customers, including major integrated oil companies, refiners, and marketers. The way take-or-pay contracts work is you have a contract with your customer where if the customer does not use the service that you're providing, they have to pay a minimal fee. So either way, if the customer uses your service or does not use the service, they have to pay a fee, which would hopefully offset some of the operating expenses that you incur. The company then says that its network of crude oil terminals facilitates the transportation of heavy crude oil from Western Canada to key demand centers across North America. Its operations include railcar loading and unloading, storage and blending in on-site tanks, inbound and outbound pipeline connectivity, truck transloading, as well as other related logistics services. On page 140 of this report, the company outlines its two operating segments. Its two reportable segments are the terminaling services and fleet services. The terminaling services segment charges minimum monthly commitment fees under multi-year take-or-pay contracts to load and unload various grades of crude oil into and from railcars, as well as fixed fees per gallon to transload ethanol from railcars, including related logistics services. The terminaling segment also charges minimum monthly fees to store crude oil in tanks that are leased to its customers. The second reportable segment, which is the fleet services segment, provides customers with railcars and fleet services related to the transportation of liquid hydrocarbons and biofuels under multi-year take-or-pay contracts. On the next page, the company breaks down its revenue by its reportable segments. We can see that for the fiscal year that ended in December 31st, 2020, the company had a big write-off in its terminaling services segment, which made the company report a loss. However, when we looked at the company's cash flow statement, the company was still cash flow positive because impairment charge is a non-cash expense which gets added onto the cash flow statement. Hence, overall, the company still had a positive cash flow number. If you take a glance at the company's most recent 10Q and look at the 3 months that ended September 30th and the 9 months that ended September 30th, we can see that the total revenue in the year 2021 was higher than what was seen at the time in the year 2020. Additionally, the operating costs are back down to the original levels, as for the year 2021, there was no impairment charges that were seen in the year 2020. Now let's go back to the annual report. On page 173, we can get an idea of the ownership of all the directors and executive officers of USD Partners. We can see that the management owns about 5% of the total common units outstanding. It's important to note that the management that we see in this company is not elected by common unit holders, but rather they're appointed by the general partner. So unlike a corporation where the common shareholders have a say and vote on the executive officers, when it comes to the common unit holders, they do not have a say and vote on who gets to be the management for this company. Everyone you see here is appointed by the general partner, and that's just the nature of the master limited partnership, where there can be conflicting interests and the interests that the management has may not align with those of the common unit holders. Now let's look at page 40 of this report, where we get an idea of the cash distribution policy that the company has. This is actually a risk factor that the company has listed, where it says that the board of directors of our general partners may modify or revoke our cash distribution policy at any time at its discretion, and our partnership agreement does not require us to pay any distributions at all. It also says that the board of directors that are appointed by Energy Capital Partners have to approve any distributions made by the company. The company then explains how the board of directors of its general partners has adopted a cash distribution policy where every quarter it would pay out about $0.2875 per unit after they have established a cash reserve and paid any expenses. However, after the first quarter of fiscal 2020, the board of directors of its general partners reduced this quarterly dividend to $0.111 per unit, or about $0.444 per unit on an annualized basis, which was about 70% below the distribution that was seen in the Q4 of 2019. Finally, the company cautioned investors not to place undue reliance on the permanence of its cash distribution policy in making an investment decision. One thing to note is that the company's cash distribution or dividends are going to depend on the cash flow of the company. And if the company has a bad year, then the cash dividends are also going to be lower than what was seen in the previous years. The company also says that once it has established that cash reserve and paid off any expenses, all the money that's left goes to the unit holders. So there is no money left for capital expenses. So when the company has to grow and invest in any capital expenditure, then it has to finance that growth through a financial firm. So it has to take on debt in order to finance that growth, or it has to issue more shares by doing equity financing. So the company inherently is not able to invest in itself with the cash that it has, since it pays out all that cash to its unit holders. So this can be a good thing, as you as a unit holder do not have to put your equity online in order to finance that capex. The financial organization, the banks, are going to finance and help the company grow, and you get to benefit once that capex leads to higher cash flow numbers in the future. At the same time, it's important to note that if the company liquidates, as a unit holder, you're not going to get anything, as the banks, the financial organizations, are going to have a first claim on any and all of the property that the company has. Finally, let's look at page 10 of this report, where the company provides us an organizational structure on how the MLP, the Master Limited Partnership, is structured. Over here, we can see that Goldman Sachs Management and Energy Capital Partners owns US Development Group LLC, and this US Development Group LLC has 100% controlling interest of USD Group LLC. The USD Group LLC has about 42.3% limited partner interest in USD Partners LP. The public unit holders would be people like us, have about 56% limited partner interest, and the USD Partners Group LLC has about 1.7% general partner interest in the company. The USD Partners LP has 100% ownership of 4 terminals and the railcar fleet services. Now that we have a brief understanding of the company's business, the organizational structure, the 2 reportable segments, and the revenue breakdown, let's review the company's fundamentals by focusing on its key ratios. Hey guys, now let's look at the key ratios. I'm on Morningstar looking at USD Partners LP. Under key ratios, we have the financials. The first item on the list is the revenue. The revenue is the top line of the income statement. This is the amount of money that the company brings in via sales. Back in 2012, the company brought in about $25 million. And for the trailing 12 months, that number had grown to about $125 million. Over the past 10 years, the company's revenue has been trending upwards. Next is the operating income. The operating income is what we get when we subtract the cost of goods and operating expenses from the company's revenue. Back in 2012, the company's operating income was about $3 million. And for the trailing 12 months, that number was about $29 million. Over the past few years, the company's operating income has stayed fairly consistent. Next, looking at the net income. The net income is the bottom line of the income statement. This is the amount of money that's left with the company once it pays for the cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes. Back in 2015, the company's net income was about $18 million, and for the trailing 12 months, that number was about $24 million. The company's net income was negative in 2020. This is because the company claimed the impairment loss in that calendar year. Ideally, we want to see the company's revenue, operating income, and net income to have a similar trend. That is, we want to see those numbers to be staying steady or increasing. After that, looking at the dividends per share, back in 2015, the company paid out about $1.11 per share as dividend, and for the trailing 12 months, that number was about $0.45 per share as dividend. The company's dividends per share are going to fluctuate based on the cash flow that the company is able to generate. Once the company has established a cash reserve and paid for any of its expenses for that calendar year, any of the cash that's left over is going to go towards distributions, and that is what the common unit holders would see as dividends. Next, looking at the shares or units outstanding. Back in 2015, the company had about 21 million units outstanding, and for the trailing 12 months, that number had grown to about 27 million units. Ideally, we want to see the company's shares outstanding number to be staying steady or decreasing. However, with an MLP structure, it is fairly common for the shares outstanding numbers to be growing, as when a company issues more units, it's a way for the company to finance its growth. And also with the executive compensation packages, it's common for the company to pay its executives by issuing more shares. Next, looking at the book value per share. The book value is what we get when we subtract the company's total liabilities from its total assets. Back in 2014, the company's book value was about $0.46 per share, and for the trailing 12 months, that number was about $0.64 per share. The company's book value per share was negative back in 2020, which implies that the company had more liabilities than assets in that calendar year. This is because of that one-time impairment charge that the company claimed, which screwed up the company's balance sheet for that calendar year. Ideally, we want the company's book value per share to be positive, which means that the company has more assets than liabilities on its balance sheet. Finally, looking at the free cash flow. The free cash flow is what we get when we subtract capital spending from the company's operating cash flow. Ideally, we want the company's free cash flow to be positive, staying steady, or increasing. Back in 2012, the company's free cash flow was $53 million. The following 2 years, the company's free cash flow was negative, primarily because the company's capital spending exceeded its operating cash flow. Back in 2015, the company's free cash flow was $35 million. And ever since then, the company's free cash flow has been positive. For the year 2020, the company's free cash flow was $45 million. And I will be using this $45 million for my discounted free cash flow DCF analysis. It's important to note that even though the company reported a loss in the fiscal year 2020, the cash flow was still positive because that one-time impairment charge was a non-cash expense. So from a cash flow standpoint, the company still had cash coming into the business. Hence, the free cash flow was a positive number. Now let's focus on the profitability of the company, focusing on the net margin. The net margin is the ratio of the company's bottom line to its top line. So it compares the company's net income to its revenue. Back in 2015, the company's net margin was about 21%. And for the trailing 12 months, that number was about 19.2%. What this means is every $100 that the company made over the past 12 months, by the time it paid for its cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes, it had $19.2 left as profit. Next, looking at the return on equity. The return on equity is the ratio of the company's income to its shareholders' equity. Warren Buffett prefers to only invest in securities that have a return on equity of 8% or greater every year for the past 10 years. Back in 2015, the company's return on equity was about 38%. And for the trailing 12 months, that number was about 280%. For an MLP, we're bound to get high return on equity numbers because there is little to no equity portion on the balance sheet, which means that when we compare income to a small equity portion, we're bound to get inflated return on equity numbers. Next, looking at the return on invested capital. This number gives us an idea of how good the management is at allocating the company's capital and getting a return on that investment. Back in 2015, the company's return on invested capital was about 9.79%. And for the trailing 12 months, that number was about 14.26%. The company's weighted average cost of capital, also known as the company's hurdle rate, is about 6.65%. And since the company's return on invested capital is greater than the company's weighted average cost of capital, we can safely say that the management is creating value for its shareholders. Finally, looking at the interest coverage. The interest coverage is the ratio of the company's income to its interest obligations. So it gives us an idea of how many times can the company pay off its interest using its income in that calendar year. Benjamin Graham, the father of value investing, preferred to only invest in securities that had an interest coverage of 5 times or higher. For the trailing 12 months, the company's interest coverage was at 5.33. Now let's look at the financial health and liquidity ratios. The first item on the list is the current ratio. The current ratio compares the company's current assets to its current liabilities. Ideally, we want to see the company's current ratio to be greater than 1.0, as that means that the company has enough current assets to fulfill its current liabilities. Back in 2012, the company's current ratio was at 1.31, and for the latest quarter, it's at 1.06. Next, looking at the financial leverage. The financial leverage is the ratio of the company's total assets to its shareholders' equity. A high financial leverage ratio tells us that more of the company's assets are financed via liabilities. As the company outlined in its 10K, anytime it has to make any capital investments, it has to finance its growth through banks or taking on debt. As every year, whenever there's any cash left over with the company, it has to pay off those cash in the form of dividends, and it cannot use that to invest in itself. And this is why we're seeing high financial leverage across the board, as majority of the company's assets are financed via liabilities. A financial leverage of 1.0 would tell us that all of the company's assets are financed via its shareholders' equity. And as these numbers get high, it means that more of the company's assets are financed via liabilities. Next, looking at the debt to equity ratio. This ratio compares the company's total debt to its shareholders' equity. Ideally, we want the company's debt to equity ratio to be less than 1.0. However, when it comes to the MLP structure, similar to the company's financial leverage, we're bound to see high debt to equity ratios. Now let's look at the efficiency ratios. The first item on the list is the day sales outstanding. This number gives us an idea of how many days go by from the day the company recognizes its sale to the day it actually receives cash for that service rendered. Back in 2012, the company's day sales outstanding was about 15 days. And for the trailing 12 months, that number was about 20 days. Ideally, we want the company's day sales outstanding number to be staying steady or decreasing. What we do not want to see is a company whose day sales outstanding number is growing rapidly, as that tells us that the company's management is being aggressive with its accounting, as it's trying to recognize its revenue sooner so that it can inflate its income numbers on its income statement. However, USD Partners' management is not playing any such accounting tricks, as the company's day sales outstanding number has stayed fairly consistent over the past few years. Now let's quickly look at USD Partners' current valuation. The company's price to earnings ratio is at 5.7. The company's price to book is at 7.9. The company's price to sales is at 1.1. Its price to cash flow is at 2.8. And finally, the company has a dividend yield of 9%. Now let's look at USD Partners' discounted free cash flow DCF analysis. Over here, I pasted the company's 2020 free cash flow that I got from Morningstar, which was at $45 million. I expect the company's free cash flow to grow at 3% every year for the next 10 years. I'm using a discount rate of 15%. What this means is I want this investment to give me a 15% return. I'm using the long-term growth rate to be 1.9%. This is in line with the 30-year Treasury yield. And what this means is I expect the company's free cash flow to grow at 1.9% after the 10-year mark into perpetuity. The company has 27 million shares outstanding and has a long-term debt of $195 million. After taking all of these inputs into account, we get the company's intrinsic value to be about $6.19 per share. And when we compare this intrinsic value to the company's current stock price, which is about $5 per share, we can see that the company's current stock is trading about 18% below the company's intrinsic value. The way we calculate this intrinsic value is we look at what the free cash flows would be every year for the next 10 years. We sum up all those free cash flows, which come out to about $257 million. Then we look at what the free cash flows would be after the 10-year mark in perpetuity. We sum all these up to get the intrinsic value to be about $362 million. From this number, we subtract the long-term debt and divide by the shares outstanding to get the intrinsic value per share to be about $6 per share. Next, if we disregard the perpetuity component, in other words, if you think that USD Partners is only going to grow for the next 10 years and then it'll cease to exist, then in the next 10 years, you can expect to get enough cash flows such that your intrinsic value would be about $2.33 per share. And finally, if you disregard the debt, in other words, if you think that USD Partners is going to grow into perpetuity, so there's no point for the company to worry about paying off its debt, then we get the intrinsic value without the debt to be about $13.4 per share. Finally, let's find out, using what-if analysis, what kind of return can we expect to get on this investment if you were to purchase the stock at the current stock price. So if we set our intrinsic value to the current stock price, which is $5.08 per share, by changing my discount rate, we run this analysis and it comes to about 16.16%. What this means is if you were to purchase a stock at the current stock price, we can expect to get an annual return of about 16% on this investment. So overall, we saw that USD Partners is an undervalued security. However, there are many risks that come about when investing in a master limited partnership. Some of the risks include the management's decisions may not be in line with those of the common unit holders. The management's incentive structure is not transparent. The common unit holders do not have the same say and voting rights as you would with a corporation. The company has to take on more debt in order to finance its capital investments, and any dividend distributions should not be thought of as predictable and permanent. On the plus side, the company does not have any commodity risk, and it has take-or-pay agreements, which most of the agreements have inflation protection built into it. So we know that the company is bound to get at least a minimal amount of revenue that would help them stay afloat. Hey guys, that is all I had for you this week. Hopefully you found this video on USD Partners LP interesting. If you like this content, please do like, share, comment, and subscribe. And if you have any suggestions on which stock I should review next, please leave it in the comment section below. I'll greatly appreciate it. Thank you.